Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. And I've put together the top 7 key market drivers I look at when I'm analyzing a real estate market. Go to sethferguson.org to download your free copy. Our guest today got his start in the mortgage industry at age 21 and has completed hundreds of short sales. He's published 3 books and speaks at various conferences and events. Ryan Wright is with Do Hard Money. Ryan, welcome to Purchase to Profits. It's great to have you on the show.
Thanks for having me. I'm excited to be here.
Yeah, we're really looking forward to this. And you got legal and you hopped into the mortgage industry. Most people don't think about mortgages when they turn 21.
I thought about it when I was like 16. My dad made me.
That's great. Well, what are your goals right now with your business and with real estate?
You know, the big thing, I'm kind of at a point in my career where I've had some success. I've learned a lot, and I'm really excited to help other people have success. There's a lot of fulfillment from that. My favorite is to help people do their first deal. A lot of my friends tell me I'm just glutton for punishment because that first deal's the hardest, and people give up and they give up on themselves and don't try. But one of my big goals is to help as many people as possible do their first deal. Yeah. I think that first transaction is like the one that it's the gateway that can give you the success you need and the confidence. So that's one of my big goals is giving people the tools, the resources, the software, the help, the capital to get that first deal on their belt, regardless of their circumstances. That's bad credit, whatever the case is. Like somebody took a chance on me one time and it changed my life, and I want to do the same thing.
Yeah, for sure. And like you said, that first deal, it separates the pack because, 80% of people thinking about getting into real estate will never get into it. They're too afraid to pull the trigger. So 100%. And so for yourself getting into the business at an early age, obviously that the goal of helping others wasn't in your head at the time. So how have your goals changed from the start to now?
Well, it's kind of the thing, like when you're getting started, in real estate, getting started in anything, business, life, whatever the case is, it's, how can I put some food on the table? You got to pay the bills. Yeah. But over time, and I kind of got taught this at a young age as well, you kind of have to have 2 jobs. You got to have your day job and you got to have your investment job. And a lot of people, your day job puts food on the table, and that day job may be being a real estate investor. That day job may be being a mortgage broker or a real estate agent or a plumber or, whatever your day job is. And your day job could evolve into being a real estate investor. But even if you are a full-time real estate investor, you still have a day job of investing that puts food on the table. Then you have to create margin with that. And then you take that margin and that becomes your investor job where you're buying rentals or doing lending or, whatever the case is, or doing some flips that you can then get some passive income so that you can have capital. So you got to look at it as having 2 jobs. There's 2 hats you got to put on every single day.
Yeah. And would you say for somebody getting started in real estate investing, most people don't really think of the investing side as a business. How would you suggest somebody approach getting into real estate investing, just in terms of how they think about the asset?
Yeah, I've said this quite frequently, but fix and flipping, real estate investing is like glorified right now. There's TV shows about it, movies talk about it. Like it's so glorified that it almost becomes, they make the process look so easy, right? So, and it's not easy. It's simple, but it's not easy. It's actually hard to find a good deal in those types of things. So it makes it seem so easy. It takes work, anybody can do it. It's simple, but it's not easy. And so I think if you're getting started, number one, you've got to treat it like a business. Number 2, you can't get emotional. I find people make emotional-based decisions. There's a book I really like called The Checklist Manifesto, and it talks about how Warren Buffett makes decisions. It's by a heart surgeon or by a surgeon, and they saved all these people lives by simply having a checklist that's like, do this, do this, do this. And investing's got to be the same thing. And that's one of the things we're able to provide for new investors is like a proven checklist. The downside to that is sometimes, or maybe more than sometimes, it's like, this isn't a good deal. And so it's really easy to get emotional, buy tickets to Disneyland, tell the kids you're taking them before you even, close on the transaction. And then it comes back like the values aren't good because there's a steep learning curve to go through that.
Yeah.
And emotionally, that can be hard to deal with. So don't be emotional. Make sure you're using a checklist. And the other thing I'd really say for new investors is just because it's a good deal doesn't necessarily mean it's a good deal for you. We'll get a new investor that'll bring like a $5 million apartment complex and they've never done a deal before. And it's like, it might be a good deal. I personally am not even going to touch that deal. I wouldn't do that deal. But a first-time investor doing that deal just seems suicidal, financially. And so those are some things. Don't get too big for yourself. Use the checklist. Don't get emotional. Those are some things I'd say, Seth.
Yeah. And like you said, with the large apartment deal, I see some people get into it and say, hey, I'm going to take this really heavy lift project on. Whereas like the returns are similar, just doing like almost like a lipstick renovation with another property, and you're in the deal for less time, less stuff can go wrong. So like you said, it's about using your head.
Yeah. I kind of have a litmus test. It's like the most amount of money with the least amount of work with the least amount of risk.
Yeah.
So that risk element, so it's this triangle, the risk, the time, and the capital that you're looking at. So those are some big things that we look at.
Yeah, and you mentioned the TV shows. As somebody who did a casting call for one of those shows, it's all fake.
Yeah,
fake.
Yeah.
So like, and that brings us to, flipping shows are really popular. Why is flipping so hard to do, but yet so simple at the same time?
Well, it's you watch the shows, and I've been on a few of those casting calls. I'm just not dramatic enough to be on it, and frankly, it's probably a good thing. With I think that it gets so glorified. Like, number one, when you watch a show like that, which I love them. Like, I've got it playing in my office. In our DHM cafe, we've got those shows playing all day long. It's like, wow, that looks amazing. Because we love transformation, right? We love transformation of anything. Transformation of people, transformation of lives, transformation of houses. Like, transformation is like, we love that as a race. And I love to see the transformation. But the problem is, with a lot of those shows, because it is Hollywood, because it's dramatic, the first thing that usually happens is like, hey, I got a phone call and we just found a property that has $100,000 worth of margin. Whoa, that happens in like 12 seconds. And that may take you 12 months to find that deal like that. And it doesn't show all the offers you have to make and all the houses you have to knock on and the postcards you have to send or the people you got to talk to and that type of stuff. So all of a sudden you take a 12-month thing and turn it into 12 seconds. Hey, we found this amazing deal. So it starts with that. And then the rehab, like all the thinking through, is this really a good deal or not? Like, what's the scope of work? What's it really going to cost us? How are we going to do that? There's a few dramatic scenes of like, oh no, the contractor didn't show up. Oh, what are we going to do? But I've been told by multiple sources that a lot of these properties have been renovated before. They use the same house, that gets fixed up. And that's no knock on them, whatever. But so then you got to go through the renovation, make sure it's good. And then there's no talk about how we're going to come up with the money to do this. Just magically, everybody's a millionaire and comes up with the money to make those things happen. And then from there, we've actually been approached saying, hey, can you fund some of the deals on these TV shows? Because, we have to figure that out. And nobody talks about that type of stuff. And then from there, you got to go through a lengthy rehab. And so I think it takes, TV shows usually 20 minutes in a 30-minute segment, and it boils down years worth of work into 20 minutes.
Yeah, but 100%. And let's talk about funding these deals now, because that's what you do with the hard money. Lots of people, I guess, if they're not familiar with real estate investing and their different financing options, might be afraid of hard money because there's lots of misconceptions. Can you explain for somebody who's new, what hard money is all about?
Yeah. So, let's just the definition of hard money is probably a good start for that. People think of hard money and they think of like Guido that's going to come bust your legs up, your kneecaps or something like that. The idea of hard money is lending on the hard asset, not the soft assets. So when you go apply to the bank and you go to Bank of America, Wells Fargo, whatever the case is, wherever you want to drive down to your local bank or credit union, they're going to ask you about your job and your work history and your credit scores and your debt to income ratio and all these different types of things. They care about your soft assets. They're saying, hey, what's this guy's ability to repay? We call those soft assets. Now, the hard asset is actually the property itself and the value in the property. They usually just want to make sure the appraisal comes in for pretty close to what you're actually buying the property for, and they're good with that because all of their risk is based upon these logarithms of who has the greatest propensity to pay us back and who will take on the risk, because those types of banks get insured. So if you don't pay, they can get money from the government to pay them to make them whole. That's the whole FHA or VA and that type of stuff, even Fannie and Freddie. That's how that whole world works. When it comes to the hard money, we're looking at the asset. We don't really care if you have a job. We don't care if you have credit scores. Now, there is a spectrum here. You've got the traditional FHA, Fannie Mae, then you've got like the hard asset lending, and then you've got some soft money that's kind of in between these where they do care about job or you can get better scores. The kind of the world we play in is with first timers where we don't care if you have a job, we don't care about your credit, we don't care about, as long as you're not a criminal and don't have judgments and collections, then we'll lend to you, but we're going to be really particular about the property because our value's all in that property. So we're going to underwrite that really heavily. We're going to make sure that property's really a good deal. And then secondly, we just want to make sure you're not a criminal and you don't have judgments. Beyond that, we'll lend to you. There's stuff in between these two spectrums called soft money, but that's kind of the idea. The hard money basically comes from lending on the hard asset.
Yeah. And sometimes people tell me, hey, I've got this good deal, but nobody wants to lend on it. Well, that's a key sign that maybe it's not a good deal.
I can assure you that if it's a good deal, you can get the money for it. Probably what's happening is you don't have money down and good credit and those types of things. If you're taking that kind of a deal to a bank, they're probably not going to do it because of the condition of the property. If you're taking that kind of deal to a soft asset or a soft hard money lender, they actually want experience of money down and good credit. But if you're going to a true, I feel like we're one of the last of the true hard money lenders. I don't really care as long as there's value in that deal. So one of two things, either you're taking it to the wrong person or it's really not a good deal. It's one of those two.
Yeah. And it's always important too, when you're getting into projects like this to really know what your exit's going to be, have a couple different exit strategies in case something happens. Just because that hard money loan is finite. That's not long-term debt. It's for a specific period of time to do the work that you have to do. And then you're either going to, do a refi or into conventional, or you're going to, sell the property, depending on what happens down the road.
Yeah. And hard money is expensive. It's really expensive. Like it's the most expensive. But it's less expensive than not being able to do a deal. So it's always how much am I making, not how much is it costing me when I'm dealing with a hard money. Does it allow me to do a deal I wouldn't otherwise be able to do? And for most people, they couldn't get a deal done anywhere else. So you've got to keep that in perspective. But as a lender, educator, lender, those types of things, I want you to pay as little interest as possible. We have a little saying around here that time kills all deals.
Yeah.
The longer it takes to make the deal happen, it kills all your profit margin. And you can go from having a healthy profit to none at all each day that goes by. And so it's really important that we have a good project plan together. It's really important that we're getting the work done on time, that we have bonuses and we have the carrots and sticks for our contractors where it costs them money if they're late. All those things are so important.
Yeah, work does not start on closing day. Work starts well before the closing day. So,
yeah, and actually, one of the things we do is we won't close you until we have our project managers have worked with your contractor and you, and we have a fully approved contractor's bid, and we have it broken down line item by line item. A lot of people wait and do that after they close, and some lenders will allow you to do that. But if they're allowing you to do that, you're taking on more risk because they're going to want more money down or good credit, and then they're going to have to sue you if something goes wrong. And most people base their decisions based upon best case scenario. You really should base your decisions on worst case scenario and hope that it becomes best case scenario.
Yeah, 100%. So let's go back and talk about your business. Have you developed any routines or rituals that have helped make you successful?
Yeah, I'd say several. One of the big things that I like to do is make sure that I'm taking time for family, make sure I'm taking some personal time, and make sure I'm taking some time for continuous learning. You can always tell if you're just getting a little bit off track if you haven't spent some time, listening to podcasts or reading books and, that type of stuff. So for me, I have adopted the philosophy. I love learning. I didn't really love college. I didn't really love high school. But once I learned that you could actually learn things that you could apply, and once I learned that it wasn't all about the boring college textbook that cost $500 that was I got a degree in marketing and management. It was worthless, the textbooks. But then you can read like a solid book that's like very actionable. That like gets my juices flowing. So I'd say continuous education. I would say making my family a priority, because you've got to keep the focus as to what's really most important in life. I find a lot of people lose sight of that because I have a philosophy that no success compensates for failure in the home. And I think making sure that stays a priority. And I would say those are probably the big things that we make some rituals.
Yeah. And, as your business was growing, did you ever hit any plateaus? And if so, how did you break through those plateaus?
Oh, I mean, every day.
Yeah.
I mean, that's the thing. I think a lot of people maybe look at you or look at me or whatever the case meant. This guy's got it all together. And the reality is, like, I don't have it all together. There's always a new mountain to climb. The guy at the bottom of the hill is looking up and being like, I want to get up there. But what you don't realize is when you get to the top of the hill, you look up and there's another freaking hill. And then you climb that hill and you look up and it's like, there's another hill. And so, it's a journey, and there's not a destination, and it's finding the joy in the journey. I've had problems in 2008 where we had relationships with banks where they cut all of our capital. So most of our capital comes from private individuals. So they put up money, we underwrite the deal, do that type of stuff. And so that's where most of our funding sources comes from. We get a little bit from hedge funds and that type of stuff, but mostly private individuals, high net worth individuals. Well, in 2008, before 2006, 2007, we started getting lines of credit with banks and institutions trying to, make more margin and that type of stuff. And we woke up one morning and the bank shut all of our lines of credit down, and we had funding obligations that had to go out, and we're saying, how are we supposed to do this? So that's a migraine headache. That's a really bad day. You've got the borrower that's ticked off at you. You don't have a way of the funding source. Somehow the bank that, big established bank had the right to call that, to stop being able to draw funds on that. We couldn't find it anywhere in the legal documents. That's a bad day. And there's more of those. We've had bad days where our lead count just got cut in half, and we have no idea why and where did it come from. We've got days where we had an investor that was supposed to fund a deal and there was a problem with it. It's always about the journey. I think the key to it is developing yourself to be the person that can solve the problems in front of you, and embracing the challenges and growing because of the challenges. I mean, people keep saying, the absence of challenge is really where I want to be, but the absence of challenge is death. Like you stop and you atrophy. It's just like a muscle or anything else if you're not solving better problems. And so, kind of my mantra is, how can I solve a better problem? And I would say today I'm solving better problems than I was a few years ago. But those could be bigger, and those could be more financially devastating or rewarding. Those could be bigger pressures. But developing yourself to be able to handle better problems all the time.
Yeah, no, that's some really good stuff. So let's talk about a Keystone deal. So a deal that made a big impact on you and your business. Is there one that comes to mind?
Well, I mean, my mind's racing. I mean, I bought a property before 2008 that I fell in love with and thought I was going to live in, and I lost $100,000 on it a few years later. I rented it at a negative cash flow and ended up moving somewhere else. That was an emotional decision. That's one of my top 5 worst. I've got another one on Gordon Avenue that's just like, when you ask the question, it just makes chills go down my spine.
The lights should start flickering every time you say Gordon Avenue.
Yeah. And it's under contract right now. But about, 7 or 8 years ago, we did a loan. We did a 5-month loan 7 or 8 years ago. We got the property valued. The interesting thing on this specific deal, there's this little pocket. And this property was in this little pocket of a bad neighborhood. We really didn't realize that, but everything around it was good. And so we used values, and we had 2 independent evaluators. We now find out that the evaluators were in cahoots with the borrower, and there was so kind of a fraud situation going on there. But nonetheless, we got the values. We thought they were good. It was easy for someone to lie about those because There were some comps within a mile. There's nothing that's sold in this immediate neighborhood. And so in the end, we did the deal. I think we wired like $100,000 on this little deal. And it turns out the deal's just not even worth that. It's probably worth $50,000. I don't know exactly. I don't have all the numbers in my head. But so we ended up doing the deal. And so then we found we had to take the property back. The borrower didn't do the work they were supposed to. We had to foreclose. That took a long time. The borrower fought us. I wish they would have spent money putting it in the property or just buying it from us than fighting us. And then from there, we thought, oh, we got a brilliant idea. Let's just rent this thing. So we started renting it. And that's when we really discovered it was in a horrible neighborhood. And then, we rented it and we never even made any money on the rents. It broke even for expenses, which was just repairs. We didn't have a loan on it because we owned the property outright because we funded it. And now we're going to lose a bunch of money and it's under contract to sell and we'll probably lose 50 grand. So, I mean, that's a top 5 worst. I might have 7 worst deals. I don't know. I should list them out someday.
that sounds like a bad, I guess year, right? Years.
Yeah, 7 years. And
Wow.
there's 2 lessons to be learned there. One lesson is there's this whole concept called sunk cost bias. So the idea is once you've invested so much into it, you keep investing more thinking it's going to get better when there's such a cost to just say, we're going to cut our losses and move on. And so I don't know. It's hard to see the future. I had another deal on Roosevelt that we took back and we could have broke even, maybe lost a little money that we rented. And that one went up in value and we did really well on that. I think the difference being the one was in a great neighborhood and the other one was in a crappy neighborhood. And that's, one of the big rules of investing, especially for new investors, is check the crime reports, make sure that you're in the good neighborhoods. And I'm not saying you've got to be like in the great neighborhoods. The way I look at it is I say, would I let my wife walk down the street by herself alone at night? If the answer to that question is no, you don't want to be there. I mean, there's crime that happens in every neighborhood, my neighborhood, that type of stuff. But the question is, would you let your wife walk down the street alone at night? If the answer is no, or girlfriend or whatever, your daughter, if the answer is no, you don't want to be there.
Yeah. And so have you made any changes to because you mentioned there was that fraud situation with the appraisals, have you made any changes in how you do your underwriting to prevent that from happening?
You betcha. Yeah, it's kind of like, fool me once, shame on me, or fool me once, shame on you, fool me twice, shame on me. I don't want that to happen again. So yeah, there's a lot of things that we've done. We've stepped up our criteria for evaluators. We've stepped up the criteria we require from them. We have better compliance on our side where we're checking that. We're having phone calls with them to make sure. I think it all can boil down to we probably got emotional about a deal and shouldn't have. Even with us, and we have a really, really good track record. Last year, our borrowers made like $33,000 net on every deal on average. So that's really good for 2018. That's fantastic. But in there's a couple of losses. We had some borrowers that lost some money, even with everything we could do. Now, typically, if it was a loser, it's because they screwed up and didn't do what we said, or they tore out, they did all this rehab that they weren't supposed to, that wasn't part of the project plan. Like, I can tell you the story on every single one of them where it went wrong. It's not like, oh no, this went wrong. There is an art and a science to it. But that said, if you don't follow the science, you're going to end up in a problem and thinking you could do better and change. If the project plan doesn't call for tearing out the cabinets and there's no budget for new cabinets and you rip out all the cabinets because you get a little too excited one night, maybe having too much fun. And then it's like, oh crap, how are we going to buy new cabinets? Oh, I'll take some money. I got 30 grand. I'll take some money from here. No, that money's for something else. Everything's earmarked. You get yourself into a problem.
Yeah. 100%. So how has getting into, the real estate business changed your life so far?
It's the number one most impactful thing I could have done in my life. It's changed every single thing about it. And really, when I think back, my dad, my grandpa had a big influence on that. But bigger than that, well, I shouldn't say bigger than that. There was also a guy named Dan who funded my first deal. And that first deal I did, he funded me without credit or income. And, by the merits of the deal, he was really an asset-based lender. That guy changed my life because that first deal that he funded for me. And that's kind of been like, I want to be your Dan. That's kind of been my mantra in that same thing. So it's changed everything. It's changed where I live, who I am, who I associate with. It's changed my financial perspective drastically. I mean, it's really cool. There's not a lot of things where you can leverage and get such a great result with an asset that typically is over the long term always going to go up in value. There's going to be ups and there's going to be downs. So 2008 prices are back or above where they were in 2008 for most demographics. So over the long run, you can win with it. There's just a lot of good things about real estate. More importantly, I think people that get involved with real estate decide they're going to take control of their financial future rather than delegating their financial success. Yeah. And I love people that are saying, hey, I want to take responsibility for my financial future. That's like the key to success, good or bad. You've got to realize, even though, we had a bad deal on Gordon, if I would have given money to a financial investor, he would have had a bad year in 2008. And in 2008 and 2009, we actually made a return, unlike the stock market lost half their money. It wasn't a great return, but we made a return, a couple percentage points. That's exciting to us. So there's going to be ups and downs. It's if you're moving in the right direction.
Yeah. And if somebody's out there right now on the fence, who's hesitating to get into real estate, even though they want to, what would you tell them?
I would say that it's always going to be scary. So what you have to do is evaluate where you're at and what is the next step into the dark that you should take, and take that step. And then you'll get some confidence from that, and you'll say, what's the next logical step? So it just depends on where you're at. So, if I don't know, if you haven't, read the book or figured what you need to do that. If you have taken the book, go make an offer. You make an offer on a house that you're never even going to buy. I don't even care. Make an offer for $50,000 worth of, when it's worth $300,000. Just make an offer so you can get that out of your system. Make the phone call. If you've already made a couple offers, make 10 more. What I would say is there's always an out. If you do things properly, you can give yourself an out through due diligence or anything else. So most things are reversible until you reach a certain point. And before you get to that irreversible point, get someone involved, us, you, whatever, get somebody that can help you to make sure, hey, that's got your back, to make sure, when we put up the money, we want to make sure it's a good deal. We're going to do everything we can to make sure it's a good deal, which is one of the benefits of a hard money lender as well.
Yeah, for sure. So Ryan, if somebody's looking to get in touch, maybe learn more about, lending, borrowing from you or investing with you, where can they get in touch?
Yeah, just come to dohardmoney.com, dohardmoney.com. Come check us out. I've got a couple of books. You can download a free book. We sell on Barnes & Noble, Amazon, all that type of stuff. But you're welcome to do that. Love to help you if there's an opportunity there and it makes sense.
That's great. Well, just want to say thanks so much for taking the time today and sharing that really good Gordon Street story.
Thanks for I'll never live this down. Now it's recorded. This is going to live in infamy. My kids are going to watch this someday.
Well, hey, that's what it's all about. If somebody can learn from it, I'm glad you brought it up. So
learn from my mistakes rather than making them yourself.
Yeah, for sure. Well, thanks again. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.